Good morning, friends. On behalf of Banking Quest, I, Gulati, extend you warm welcome. Friends, in this training program on risk management in banks and NBFCs, we designed this training program in three levels. Already, we are completed level one last Sunday and last Sunday. And friends, this program we started on level 1 we started on 23rd of April, and on 30th April we completed this program. During this level 1 there were 6 sessions, and sessions were introduction to risk in banking business. It was deliberated by Professor Rajesh Mahajan, former general manager risk management, Bank of Baroda. And second session was overview of risk in banks, and it was discussed by me, Tilak Gulati, Chief Executive, Banking Quest. Third session on organizational structure for risk management in banks was deliberated by Mr. Ambrish Nanda, former Chief General Manager and Chief Risk Officer, United Bank of India. Credit risk and causes of credit risk was deliberated by Professor S.S.N. Murthy, former Deputy General Manager, Union Bank of India, and former Senior Vice President, Indian Banks Association. Fifth session was asset liability management and interest rate risk. It was deliberated by Mr. K. Srinivasa Rao, Adjunct Professor, Institute of Insurance and Risk Management, Hyderabad. And the sixth was on Basel Accord 123, deliberated by me, Tilak Gulati, Chief Executive, Banking Quest. Friends, today we are starting the level 2 of this risk management in banks and NBFCs training program. And this will continue this Sunday, 7th of May, and next Sunday, 14th of May. In level 2 also, we are having 6 sessions. Today, we are going to deliberate upon three topics. These are measurement of credit risk, will be deliberated by Mr. S.S.N. Murthy, former Deputy General Manager, Union Bank of India. Liquidity risk management by Professor Ambrish Nanda, former Chief General Manager and Chief Risk Officer, United Bank of India. And risk rating process by Professor Rajesh Mahajan, former General Manager, Risk Management, Bank of Baroda. I have the pleasure to announce that we have with us Mr. Mohan Tanksale. Mr. Mohan Tanksale, Chairman and Managing Director, former Chairman and Managing Director, Central Bank of India, and former Chief Executive, Indian Banks Association. On behalf of Banking Quest entire team, on behalf of participants, I give you heartiest welcome, sir. Without now, Mohan Tanksale is a well-known personality in the banking industry, and he has given a new direction to the Indian banking industry. I request Mr. Mohan Tanksale to kindly inaugurate this training program with your inaugural address, sir.
Thank you very much, Mr. Gulati. All my dear banker friends and my friends from NBFCs, very good morning to all of you. I'm indeed happy to be part of this inaugural session and compliment the Banking Quest in conducting a training program for bankers and NBFCs on risk management, uh, which according to me is the most important and most relevant subject in today's time, when we have to really operate in a very volatile and complex financial sector. My compliments to Banking Quest and all the faculties, and my best wishes to all the participants. I had a pleasure to be a part of the level one also for a little interaction, and I am very confident that those who are in level one and those who are now for the first time, you will find these programs to be extremely useful. Let me tell you, I would like to be very candid in saying, I wish we had such program when we were at the field level. We were at the maybe middle management level when we used to take a credit decision. The coverage which is there is fantastic. That is the risk rating process. I think itself is a big thing where you have to discuss the internal, external rating. What are the? I'll take some of the points which I would like to bring out. Your measurement of credit risk, liquidity risk management, operational risk, uh, capital adequacy, Basel guidelines. So coverage is very, very, I'll say comprehensive and very, very useful. I'm very sure, friends, when you will get these inputs, of course, not that you do not know about it, you are all part of the risk management department. But then the perspective about the subject has to really be a little different, because I have very strong perception that it is said that the biggest risk is not taking a risk. And friends, I am sure all of you, despite the fact that the credit growth is good now, it is said that the bankers are credit averse. And thus, I very strongly feel that the risk management department and the officials operating in the risk management department in the controlling offices have a role to play as a facilitator to the operations and the credit, the people who are operating in the field, to take the informed credit decision. My thrust is informed credit decision. It's very, very important that people have to take credit decision. They cannot be credit risk averse. It is their dharma to take credit. But then in order to see that they in future, because today unfortunately the bankers always talk about three C's and all those things. So I don't want to bring out those things. Those basically it is the empowerment of knowledge which is very important. And once you have imparted, you have this proper perspective, and you are passing it on in your own respective banks to the field functionaries, you will see that people are more open to take the credit decision. Friends, uh, we talk of the various kind of risk, but today I want to bring out a different part of a risk. And today's time, the risk of stakeholders' perception is probably one of the most important risks. We talk about the reputational risk, we talk about, but every stakeholder, be it your account holder, be it an outsider, be it government or whatever it is the stakeholders' perception which makes them take the decision. And if you have seen the various failures in the US in recent last 2 3 months, here the moment the market perception is that, oh, it is unsecure to keep the money in this bank, there will be a run on the bank. And here I would like to really refer to a very good article. It is in the Economic Times Wealth, dated April 17th. Is your bank safe? I'll request Mr. Gulati that if this article can be pulled, if not, of course, I can send you the photocopy and all that. But I'm sure from the website you can pull this, and you can share this article with the colleagues, where how the stakeholders are shareholders, stakeholders are your depositors, your borrowers, and the potential customers of the bank. And thus, I think all of us have got to really ensure that the stakeholders' perception in terms of our bank is positive and is right. And that will be done only when we are growing, we are giving good, what do you call, the balance sheet results. I'm very happy that today the balance sheet results are really coming very, very positive. Uh, if I really refer to some of my thoughts, uh, some of my experience which I have undergone, let me tell you, friends, I don't know how many of you were part of the 2008 crisis. Sorry, 2009, 2008 global meltdown. So 2008 global meltdown, let me tell you, that was the time when the Indian banking industry claimed itself to be very resilient, and it was so. Let me tell you, we were all having a wonderful balance sheet size, flush with deposits, liquidity was enough, our efficiency ratios were good. If I tell you the 2008, 2009, most of the banks, their ROAs was 1 plus, ROE was 15% plus, and such good numbers. But then what happened that all of us took a call of taking exposures on the various real estate, various infrastructure projects, and all that. And probably that was one sector which were not having enough information. And as a result, from 2012, 13 onward, we all started seeing the problems in the industry. And I think all of us have gone through that brunt. I was incidentally, although I retired from central bank in 2013, I was a part of the IBA as a chief executive up to 2016. And all the problems really came during that period. And thus, what are those learnings from those points? I would like to really share with you. And those learnings, according to me, the first thing that please tell our people who are in the field that you are not a money lender, but you are a partner in the enterprise. Your stakes are 75%, the promoter stakes are 25%. And if you want to make sure that this 75% is secured, then I must be knowing the project and the enterprise from a perspective of partnership. That if I had 75% partnership, how would I monitor this account? How would I allowed the transactions in this account? And that is my first suggestion to all of you, that don't be a lender. We are not here to earn only interest, but we are here to take, ensure that the depositors' interest and the stakeholders' interest is properly protected. And that's possible. Second part is that as a lender, we have to understand the complete life cycle of a borrower. When I say complete life cycle of a borrower, it means whatever are the activities which take place with your credit lines, unless you are, I mean, your amount is paid off, you have to understand each and every phase. What is the what do you call the two concept evolved out of it, that is KYCC and KYBC. That is know your customer's customer and know your borrower's customers. We talk of supply chain, there are buyers, there are suppliers. Anything going wrong on either side of the customer can impact it. And that is what we say, that the credit life cycle of the borrower has to be well understood from a perspective that with whom is he dealing as a procurement of goods, to whom is he selling the goods, is he likely to get the payment back, what kind of a labor policies is following, so on and so forth. And thus the complete credit life cycle. This will give you the early warning signals. And let me tell you that unfortunately, we bankers, we get into action only with today, fortunately, SMA 0, SMA 1, SMA 2, and day one, we start sending the SMS and all that. But then we all really take care, worry about my interest is not paid, my installment is not paid. But why my interest is not paid and why my installment is not paid, what could have been the cause for non-payment, I think is more important to me. And those causes can be known when you are following the early warning signals which are available in the system. And thus, to have those early warning signals, you will have to use a lot of technology, the data science, a lot of the information is available. Let me tell you that today data science is providing you a small information like people have not paid the GST in time, they have not paid the EPFO of employees in good time. And these are all signals that there should be some liquidity kind of an issue. And thus, I think there is a great need that the moment you are coming across any causative things, you get into the root cause analysis and try to find out what are the internal causes, what are the external causes. How do we really ensure that the internal causes are addressed and the external causes we understand very well? Today, people are even reading that whether the directors on this board have, if they are deserting the board, is there a problem? if the chartered accountants of this company is, there is a analysis available today that how many chartered accountants have left in this the corporate world, how many directors, independent directors have left. These are all signals that something is going to get wrong, and probably as a banker, it's very, very important that you all try to, uh, I mean, beyond the guidelines, RBI circulars, beyond the, we have to inculcate all these habits to understand. And that is why you say that get engaged with the life cycle of a borrower. The another important, when Murthy is dealing with the credit risk, I will suggest that how the life cycle of a letter of guarantee and letter of guarantee, letter of credit and letter of guarantees to be monitored is very, very important. We issue the guarantees and we wait for the due date. Whether the performance is happening, I have guaranteed performance. Performance is a day-to-day affair. If I have guaranteed mobilization advance, that is the financial guarantee. It means, yes, I can understand earnest money deposit. You don't have to really do anything till you get to know whether you got the contract or not. But performance guarantee and the mobilization guarantees are such which needs a monitoring from a different perspective. Whether he is really performing, whether there is any likelihood of his non-performance, and which will result into the invocation of bank guarantee, which will result. So, I mean, those are things. Similarly, on the letter of credit, you may be very comfortable on the DP side LCs. What about the DALCs? The DALCs which get paid after 90 days, 180 days, whatever may be the DA period. What happens during this period? How is he really ensuring that on the due date he is able to pay this dues what he is supposed to pay? It means again the life cycle of a borrower, whether whatever raw material procured, he has manufactured, he is able to sell, he is able to get the sale proceeds, or he has got enough credit lines to discount the sale and pay the LC. I think those are some very practical things which I thought I will bring out, because this is what we faced when at different levels. I've been a branch manager for 22 years, regional manager, zonal manager, and all those levels. So I will suggest that then one very humble suggestion to all the bankers, don't try to look for a quick fix solution. Somehow I avoid the account turning NPA. NPA is 90 days. You have to start 0 day and make sure that you have a solution before you either you get into a short-term restructuring, medium-term restructuring, or whatever action you want to take even before the 90 days out. I think if you are able to do that, probably you are justifying to be a partner of an enterprise, securing 75% exposure which you have. Friends, as you know that the credit, I mean, our financial numbers are very good for the banking industry. The credit growth is definitely going to be there, and it's going to be there again in the infrastructure, and a lot of capex project lending will happen. And try to see that this project lending, again, you have to look at some of the basic things. The projects get executed over a period of 2 3 years. Where from does he bring the capital? Most of the failures in the project are those where they didn't have their own capital, which is called a clean capital. They create the capital out of the borrowing and again leverage, which is called over leverage. I am sure all of you know about the leveraging, which was being talked about in 13-14, and thus kindly try to. Similarly, I think very important is the monitoring of the cash flow in the account, particularly in the consortium and the multi uh, lending accounts, where you do not really have the control on the flows, but then you have to really at least monitor yours. You have to try to get the information from the consortium members, multiple bankers, and try to see that the monitoring is done properly. Here, I would also like to say that if you are dealing with the export and imports, you have to be equally conscious of the market scenario, the interest rates risk, the geopolitical issues. I mean, these are all things which impact the non-payments on due dates, and thus I will request that these are the things which one has to take care of. I have come across a very good article, Gulati. It's in the Indian Banker of November 19, Balanced Scorecard Approach of Credit Appraisal. I think I might have shared with you in the last. Uh, Kindly share this article with the, the participants, which talks of really that how do you really address the risk of adverse selection, default risk, exposure risk, and it talks of the financial scorecard, customer scorecard, internal process scorecard, learning and innovation scorecard. I'm very impressed with this article, and thus this article can be shared. I would also like to refer. There is an article in the IBA bulletin of December 22 on stress testing. That is, I will say, is very, very informative again, and very practical aspects have been covered in that. And thus, uh, I think our participants who are in the risk management department, as I said, friends, you are the facilitator. You are not just a watchdog that you created certain checklist, you created certain guidelines, and you will only ensure compliance. You have to ensure that whether your field people can really comply with it. So if I don't look at this aspect of it, then it becomes more of an academic initiative rather than the practical and operational initiative. You will learn so many things academically, but then the implementation of the academics into operations, into day-to-day operation, is the art of a banker. And a successful banker is one who has understood this part and tried to implement it. And thus, I will again repeat, you are all facilitator to see that your people in your bank are in a position to take the credit risk which they are supposed to take, and they are also ensuring very good quality of the assets. I would like to uh, uh, add one or two more points. That is, uh, I'm sure my faculty members are definitely talking about the concentration risk, about the diversification of the risk into various products, geographical distribution. Today, you have got almost every information available. CIBIL or any other credit bureau gives you the information. What are the behavioral pattern of the borrower in a particular geography? I think they have got district wise or maybe even the what you call pin code wise information available. That kind of information is available. The data science companies which are servicing the banking industry are in a position to give all possible information. So making use of information probably is one of the point which I like to give a thrust, where you can ensure the concentration risk, diversification risk, and of course composition of assets. Typically, let me tell you, when I was reading this article of Is Your Bank Safe, it talks about that the banks who are heavily depending on the bulk deposits, who are heavily depending only on current deposits, you will say, sir, CASA is very good. CASA has to be 50%. Yes, it's good, but it should not be very volatile kind of a current deposit, which takes you to the liquidity problems. And all these banks which have got into problem in US are because of their not ensuring a very qualitative composition of the assets and the liabilities. See, the balance sheet is not the size, balance sheet is the qualitative composition of the assets and liabilities. If you can take care of that, friends, that will be great. Uh, I will like to close my opening remark with my uh, suggestion that let me tell you, friends, that bankers should not be credit averse, but take informed credit decision. Banking is a lifeline of economy. Always keep it in mind that if the banking fails, the economy fails. If the banking is strong, the economy goes strong. then bankers should believe in ethos of credit by choice and not by chance. I should not be doing any advance just because it's an opportunity. I should be doing it after very thorough due diligence, which is called credit by choice. It means you have to do a proactive due diligence. Rather, I will say that the banker should work proactively, that who should be my customer, which customer should I should be brought into my fold. If that kind of efforts are made by the bankers, that will be a very good thing. And the last, before I close, risk is not the responsibility of the risk management department or few people in the credit department or at the operations. Risk has to evolve as a culture in the organization. It has to be an organizational culture where people understand that we are an organization where we have to take risk, and thus risk has to be understood at all levels, whether it is at the desk level in the branch while opening the account, whether I am opening, doing the proper KYC, I am getting into any kind of money laundering or kind of those issues. So I think the risk has to flow across the organization, and it should be the organizational culture which has to imbibe that how to understand the risk. I will say the risk culture across organization should disseminate, but responsibility lies with the risk management department. I think with these words, my best wishes to all of you, my best wishes to all the faculties, Mr. Gulati. I am sure the participants will be immensely benefited by your program. Thank you very much.
Thank you, sir. Thank you very much